Over the past 6 months, the exchange rate between the US dollar and the Russian ruble has shown a major downward trend in the ruble's value. On November 1st, the ruble closed at 98.25 per US dollar, reflecting a steep decline in its purchasing power. This marks a substantial 14% drop in just 4 months. At the end of July, 1 US dollar was worth 84.3 rubles, showing a major decline in a relatively short period. For a currency as major as the ruble, a 14% loss within 4 months indicates severe economic challenges. This trend shows a strong US dollar in contrast to a weakening ruble, and while it might seem simpler to view this trend as a drop in ruble terms, showing the dollar's strengthening gives a clearer picture of the currency movement. Looking at the ruble's current rate compared to historical values, there has been a very sharp decline. For instance, back in January 2006, 1 ruble was equivalent to 0.354 US dollars, while now it has dropped to 0.0102, demonstrating the ruble's erosion over the years. Viewing these changes in terms of rubles per dollar, rather than the other way around, provides a more straightforward perspective on this depreciation, given how much the ruble has weakened. While Russia has shifted much of its international trade away from the US dollar, the ruble's performance against the Chinese yuan tells a similar story. The exchange rate movement between the ruble and the yuan over the past year has mirrored that with the dollar, signaling a broader decline. This consistent pattern against 2 major currencies points to deeper economic struggles impacting the ruble's strength globally. The Russian ruble has also seen a sharp decline recently, especially against the Chinese yuan. In late July, 1 yuan traded at 11.7 rubles. Now it is around 13.8 rubles, which is a drop of about 15%. This loss is even more severe than the ruble's decline against the US dollar. This fall is a big concern for Russia, as China has become its top trading partner. So the ruble's weakness directly impacts its trading power with China. A currency's value often shows the strength of a country's economy. When an economy is thriving, demand for its currency usually increases because foreign investors and trade partners want to hold it. But Russia is seeing the opposite effect. The ruble's value has dropped, mainly due to a lack of demand, which is tied to sanctions and trade disruptions. These sanctions have limited Russia's ability to sell goods internationally, causing fewer buyers for the ruble. As demand falls, so does its value. Russia has also shifted its trade focus to countries like China and India, avoiding Western markets. However, these new partners prefer using stable currencies like the yuan or the dollar instead of the ruble. So even though trade with these countries is up, they are not using rubles, which limits the ruble's role in these transactions. This is one of the main reasons why the ruble is not seeing any increase in demand, even with higher trade volumes. After the invasion of Ukraine, President Putin aimed to make the ruble a major trading currency for Russian exports, particularly energy. However, this idea has not caught on, partly because major trading partners are cautious of the ruble's instability. Even as Russia exports large amounts of oil and coal to countries like China, payments are mostly made in yuan or dollars, further decreasing the demand for rubles. However, the ruble's decline has greater effects. With a weaker ruble, imported goods become pricier, causing inflation. Since a lot of consumer goods in Russia are imported, this means higher prices for everyday items, which affects Russian households. The central bank might try to support the ruble, but doing so is not easy with ongoing sanctions and economic pressures. The increased use of the yuan in Russia-China trade also strengthens the yuan, while indicating Russia's limited control over its currency's international use. Each trade deal in yuan raises demand for the Chinese currency, increasing China's economic influence in these transactions. This reliance on other currencies shows Russia's challenges in establishing the ruble as a major trading currency. The ruble's decline affects prices within Russia and shows how much control Russia has lost over its own currency in global markets. The Russian economy is facing a tough battle with inflation, largely caused by the recent sharp drop in the value of the ruble. As the ruble weakens, prices within Russia continue to rise, making everyday goods and imported items more expensive. This problem is especially noticeable with imported goods, as the weaker ruble means Russians must pay more for products priced in foreign currencies. Over the past year, inflation has increased sharply. In September 2023, inflation was at 6%, but it has since increased to 8.6%, showing how fast prices are going up. This trend is directly linked to the ruble's fall, which has created a situation where imports, even with stable international prices, cost more in Russia due to the unfavorable exchange rate. To understand the impact of the ruble's depreciation on prices, consider an example of an imported item priced at $1 in the international market. At the end of July, the exchange rate was about 84.5 rubles per US dollar, meaning that this item would cost 84.5 rubles in Russia. Today, however, with the exchange rate closer to 98.3 rubles per dollar, the same item now costs 98.3 rubles in Russia. Despite the international price remaining the same, this marks an approximate 16% increase in price over just a few months, surpassing the current inflation rate. Essentially, as the ruble continues to weaken, all imported goods, from technology and machinery to everyday consumer products, become more expensive for Russian buyers. To control this inflation, the Central Bank of Russia has raised interest rates. In October 2024, the bank increased the key interest rate by 200 basis points, reaching 21%, which is the highest level since 2003. This increase was more than what market experts had anticipated and shows a proactive approach to tackling inflation. However, these high interest rates have their own set of challenges. With such a high borrowing cost, both businesses and individuals find it expensive to take out loans. This restricts investment and consumer spending, potentially slowing down economic growth even further. The decision to hike the interest rate to this level follows the extraordinary steps taken in 2022, when Russia initially raised rates to 20% in response to the economic instability that followed its invasion of Ukraine. Since then, inflation has remained high, partly due to Western sanctions and labor shortages. The sanctions have limited Russia's trade options and restricted foreign investments, making it harder for domestic companies to expand or increase productivity. The labor shortage, driven by the loss of military-aged males to the war, has also strained the economy, reducing the workforce available for production and industry. Another factor worsening inflation is Russia's current trade imbalance. The economy depends heavily on imports for essential goods, technology, and components. With the ruble's value decreasing, the cost of these imports rises, and businesses must pass these costs on to consumers, leading to further inflation. At the same time, fiscal policy decisions in the 2024 federal budget have added pressure. The Russian government has adopted an expansionary fiscal policy, increasing spending on public projects and defense, which further contributes to inflation by boosting demand within the economy without an equal increase in supply. While Russia has tried to redirect trade towards non-Western countries, such as China and India, the reliance on foreign currencies for these transactions still places a heavy burden on the ruble. Trade partners are hesitant to deal in rubles, preferring more stable currencies, which reduces the demand for the ruble and weakens its position further. This lack of demand for the ruble makes it difficult for Russia to support its currency on the international stage, resulting in an ongoing cycle of depreciation and inflation. When a currency weakens, exports generally become more attractive because they are cheaper on the global market. For instance, a Russian product priced at 84.5 rubles in July would have cost $1. But with the ruble now trading at about 98.3 per dollar, the same product would theoretically cost around 86 cents, making it cheaper internationally and potentially boosting demand. However, Russia faces specific challenges that limit these advantages. Firstly, Russia's major exports, such as oil, gas, and coal, are not priced in rubles but in US dollars, Chinese yuan, or other foreign currencies. This limits the direct benefits of a weaker ruble. Russia's fossil fuel export revenue has been on a downward trend. In early 2022, daily fossil fuel exports reached around 1,200 million euros, but by 2024, this figure has consistently declined, with current levels averaging closer to 500 million euros per day. This sharp decrease indicates falling demand, sanctions, and shifts in the global energy market, rather than any impact from the ruble's depreciation. Coal exports, once a major portion, have seen a steep drop, while revenues from LNG and pipeline gas have also declined. Crude oil and seaborne oil products, which once brought in high revenues, have also reduced, adding to the challenges. Secondly, even when Russian companies earn more rubles from dollar-denominated exports due to the weaker ruble, government policies require them to convert about 90% of these earnings back into rubles. This rule prevents companies from holding on to foreign currencies that could offer some stability. As a result, they are forced to absorb losses when converting back into dollars or yuan for future transactions, especially if the ruble continues to decline. If Russian companies could retain their foreign currency earnings, they could better shield themselves from the ruble's instability, but current regulations leave them exposed. This means that the expected benefits of a weaker ruble are not materializing, and Russia's export-driven revenue continues to suffer, impacting the economy as a whole. A major concern for both companies and individuals in Russia is the loss of their wealth's value due to the ruble's decline. For example, a person with 1 million rubles in savings might feel financially secure within Russia. However, in terms of international value, that million rubles was worth about $11,800 at the end of July. Today, as the ruble has fallen by approximately 14%, the same million rubles would now be worth only around $10,200 if converted to US dollars. This decline means that the international purchasing power of their savings has dropped drastically, impacting their ability to afford goods and services from abroad. This loss in purchasing power affects both individuals and companies that rely on imported goods or need foreign currency for international transactions. As the ruble weakens, the cost of importing essential items rises, which companies must either absorb or pass on to Russian consumers in the form of higher prices. As the value of the ruble continues to erode, people often lose confidence in their national currency. In countries like Argentina and Turkey, this has led to a phenomenon known as dollarization, where people start to prefer holding foreign currencies, like the US dollar, over their local currency. This preference arises from a desire to protect wealth from daily losses due to currency depreciation. In such situations, people may shift their savings into foreign currencies, seek to buy assets outside their country, or even invest in cryptocurrencies, all in an attempt to safeguard their wealth. In Russia, this trend is becoming increasingly relevant. With the ruble's purchasing power decreasing, individuals and businesses are likely looking for ways to protect their assets from further devaluation. This lack of faith in the ruble could, over time, lead to shifts in financial behavior, as people seek alternatives to maintain their financial security amidst the ongoing economic uncertainty.